Hello and welcome to our webinar on essential updating on the charity financial reporting framework at the moment. I'm Sudhir Singh. I head the not-for-profit team at MHA, and I think we've got a very exciting webinar in front of us. This is a topic that's interested me for a long time, about 30 odd years in terms of charity financial reporting, and yet the future, it looks very exciting nevertheless. So we have a webinar. It's going to last about 75 minutes. There will be a question and answer session at the end, and we will allow those questions to be asked. Please do use the Q&A button that you'll see on the screen to ask those questions. Don't be shy. Do ask your questions as we go along, as well as at the end, and I'll try and collate them and ask our team those questions for you. Just to highlight that this webinar is being recorded, so no need to take any notes. You can, in a couple of days' time, it will be on our website on the MHA Trustee Hub, and you can watch again the webinar and all the slides as many times as you wish. You can invite your colleagues, friends, children, pets to watch if you wish as well. So it'll all be readily available on demand. And just to emphasize that that is very much our commitment to the sector at MHA. We are very keen to provide appropriate resources, guidance and support, particularly to trustees, governance and good practice. And you can find all of that using the link on this slide at the Charity Trustee Hub of MHA. So, without any further ado, I'm going to introduce our speakers for this morning's webinar. And it's really hard to think we could have a better selection of more accomplished speakers for us on this topic. Start by introducing Stuart Mackay, who's a fellow not-for-profit audit partner here at MHA. And Stuart is going to be talking about UK charity financial reporting and the UK SORP, and he has a real insight into that because he sits on two of the engagement strands for the current charity SORP consultation. Second speaker is Paul Winrow, and Paul is our technical partner at MHA, and Paul has a real long-term interest in charity financial reporting, and currently he's contributing to the practitioner advisory group of a really interesting international project, the International Financial Reporting for Not-for-Profit Organisations, also known as IFR for NPO, and that project. And that's going to be what Paul is going to cover this morning. Also have with us Rich Hall. Rich is a member of our team and heads our work in terms of sustainability and stakeholder assurance. And this is an area that Rich has extensive experience in, over 15 years experience of considering sustainability matters and reporting. So really well placed to give us some thoughts about that really interesting area for us, and very relevant at the time of COP26. And finally, Jim Clifford, who is CEO and Director at Sonnet Advisory and Impact, which is a specialist not-for-profit consultancy. And we have an association with Sonnet between us and MHA and Sonnet. And we work together regularly. And indeed, I've been working with Jim for probably about 18 or so years. So I know that Jim will have a lot of very useful insight for us. Looking at what we're going to talk about today in terms of an agenda, before I take you through this agenda, we thought it would be really interesting to understand a little bit about your thoughts about charity financial reporting. So I've got a little poll here that I'm going to launch, and what this poll is asking is your thoughts about the current framework for charity financial reporting. So the question is, currently, the framework for charity financial reporting, does that convey well a charity's financial results, its governance, its aims, its strategy, its impact, It's ESG, and hopefully you know that's environmental, social and governance performance. It's risk, and the charity's financial resilience. So do just spend a moment just thinking about that. You can vote on more than one of those areas, we'll leave it a moment or two and see what the poll says in terms of what we think about the effectiveness of the current reporting framework before we start moving on to thinking about what may be coming over the horizon for the future. So I'll just give that another 10 seconds or so before I end the polling, and I'll share the results of that with you. So just a couple more seconds if you want to finalize your polling results. And okay, I think we will, looks like a few last minute changes to give you 1 or 2 seconds more. Looks like it's settling down. So I'm going to end the polling now, and I'll tell you what the results are. So what you've told us, which is really interesting, is in terms of effectiveness of reporting, well, 90% of you think the current framework reports financial results well. 61% think governance is well covered, and a little more than that, 68% think aims and objectives are covered well. So all those areas, results, governance and aims and objectives, strong results. Less so in terms of strategy, 32%, risk, 22%, a little bit more on financial resilience, so that's reporting on reserves and going concern, so I guess that's probably expected. But the low areas, only 6% of you consider impact is well conveyed in the current financial reporting framework. And interesting for you, Rich, in terms of ESG, 0 in terms of coverage, and maybe that's not surprising. So hopefully you can see those results in front of us. So coming back to what we're going to cover in our webinar. So we're going to start by considering international financial reporting for not-for-profit organisations, the consultation there. This is a really major project. One of my clients called Momentum, a charity, UK and international charity, is managing this project. I couldn't believe when I discovered that the budget for the project was several million pounds, but now I've got involved in the project. It is extremely thorough and very high quality. So I think what Paul is going to tell us is going to be of real interest, looking at that international angle first of all. Then we're going to move with Stuart to a domestic angle, looking at the UK charity sort consultation. And I know there's been a very wide range of issues being considered, so I think Stuart will give us a little bit of an early warning of what's emerging. And then finally, we're going to have a joint session between Rich and Jim. They're going to be considering these two really interesting emerging areas for reporting, impact reporting and ESG. Having said that, impact reporting, I remember talking to clients, first of all, more than 20 years ago. And then about 18 years ago, Jim and I started talking about impact reporting, and suddenly it all became much clearer to me. And I'm sure it will be to you too in the session that Jim and Rich is going to cover. And we'll have an idea of what's going on over the horizon. And then we're going to end with just a short Q&A session. So hopefully that's a good introduction. I'm going to hand straight on to Paul to talk about IFR for NPO. Over to you, Paul.
Thanks very much, Sudhir, and good morning, everybody. Interesting there that only 90% said the financial results are well conveyed in current reporting, which suggests that maybe there is a need for the IFR for NPO projects, and also for Stuart's session in terms of the charity sort. So Sudhir's already mentioned that this project, developing international financial reporting guidance for non-profit organisations, or IFR for NPR. I must admit, neither of them are particularly easy to say. I may just refer to IFR when I'm mentioning the project as we go through. So if we can move on to the next slide, please, Deepa. So this is the full title of the project. We can move on from that one as well, please, to the next slide. to talk about the objectives. So what I'm going to do today is to talk about, give you an overview really of the IFR project, talking about the what, the why, the how and the when of the project. Starting off with what are our objectives in starting off this project, which, as Sadia mentioned, is being managed by Humentum and also by SIP for the Chartered Institute of Public Finance and Accountancy. So the main objectives is to try and improve the quality and transparency and credibility of non-for-profit financial reports, to support the provision of financial information that's more useful for decision makers, for demonstrating accountability, and trying to balance the needs of preparers and users as well. So trying to take account of multiple stakeholders, and also to address any specific not-for-profit issues, particularly around financial reporting. So you'll see as we go through how we're aiming to meet those objectives. If we move on to the next slide, just thinking then, what do we mean by financial reports in this context? What is the financial reporting that we're trying to deal with? So if we look at this slide, all the transactions that happen in a not-for-profit organisation hit the accounting systems and then come out in various different types of reports. And there are just three summarised here: internal reporting, so management accounts and other things, donor reports that you may send off to donors and grant awarders, and then there's general purpose financial statements, and that's what we're talking about in terms of the IFR project. It's about the general purpose financial statements or the accounts, for want of a more simple phrase. There is another project that Humentum's working on, looking at harmonising donor project reports and the formats and how they can be done. That's a story for another day. That's not what we're going to talk about today. So as I say, we're looking today at the financial statements, the accounts of the charities, so not-for-profit organisations. So if we move on to the next slide then, so now we know what we're looking at. It's the accounts. Which stakeholders are we trying to take account of in this project, and who are we being mindful of? And you'll see here in the middle, they've broken down into three broad categories of users of the accounts, preparers of the accounts, and auditors. We also have an interest. So in terms of users, we're looking at donors, and for donors there is a separate donor reference group that the IFR project has access to in terms of obtaining feedback from that reference group. Looking at the needs of regulators, standard setters, of clients and the public at large. So we've got that broad range of users in our minds as we go through the project. In terms of preparers, that's preparers of not-for-profit financial statements. So that's kind of a bit obvious that the preparers are from non-profit organisations. And then from the audit and assurance perspective is the independent assurance providers, the audit firms, who will be auditing the financial statements that will follow whatever guidance we end up coming out with. So having considered the stakeholders, if we move on to the next slide, the what, effectively, of what are we going to deliver from this project, and what we're trying to address. If we move to the next slide, Deepa. There have been a number of a number of current problems or issues that have been identified around international financial reporting for non-profits. First of all, there are no international standards. Obviously, there are international standards in the commercial world. There's also the international standards in the public sector, but there's nothing internationally specific for NPOs. And what that can mean is you've got inconsistent formats for financial reporting that may not necessarily meet the needs of funders and other users. So whether we've got something that's fit for purpose for all stakeholders, transparency and risks around double funding with fraud and things like that. So that there are issues that are trying to be addressed. The solution that's been identified is this IFR for NPO project, and the idea here is to produce guidance, which I'll talk about in future slides, to go alongside existing accounting standards to help address some of those current problems. There will be decisions that need to be made at jurisdiction level, and also individual organisations and funders may need to make decisions around how much of the guidance is adopted, but it should lead to a more resilient and a more accountable non-profit sector more broadly. And the solutions that will fall out of that guidance as we go through as kind of reflecting our objectives on that first slide, are more useful, transparent and consistent financial reporting. Non-profits ought to be able to demonstrate capacity and attract funds more easily. Funders might be able to more reliably assess different MPOs, particularly when requesting funding and so on. It should simplify audit and assurance, hopefully, as well. and hopefully, through this project over the next few years, we will develop an international not-profit financial reporting community. Now, we understand that, you know, certain jurisdictions like the UK have got the Charities SOP and a well-established financial reporting, and the comments we're making here about transparency and consistency and so on may not necessarily apply in every jurisdiction, and may apply to greater or lesser degrees. But there are large parts of the world that aren't fortunate enough to be in the position that they've got something like the Charities SOP. So although the UK is pretty well covered, and Stuart will talk more about future plans on that in a bit, it is important that countries like ours are fully involved in these projects to help share that learning with the rest of the world. So that's kind of the what we're going to deliver. How is this going to be delivered? If we move to the next slide, please. So there are two advisory groups that form part of the project. The first group is the technical advisory group, and this is effectively standard setters and regulators, and their role will be to write the guidance, so to take the accounting standards and write the guidance that will follow. And then there's a practitioner advisory group, which is a broad range of stakeholders and users, includes preparers. There are many preparers on there, includes several auditors as well. So we've got that broad perspective on the practitioner advisory group, and we take that's where I sit, as Sadia mentioned. We take what the technical advisory group produces, we knock it about, we provide feedback on it, and hopefully enhance what the technical advisory groups produce before it goes out to consultation. So that's how those two advisory groups fit together in the broader project. If we move on to the next slide, please. This summarises the project at a high level in terms of timeline. So phase one is more or less complete. That's the initial consultation paper to try and get structured stakeholders input to the broad project. That's been completed, and there's some more information on that shortly. The intention is to start producing the exposure draft of the guidance from next September, and there's a slide which sets out more detail. We're going to do that in stages rather than all at once. And then the intention is that final guidance will be ready for adoption by early 2025. So there's a bit of a slow burn, but these things do take time to get the exposure drafts out, the feedback and the iterations. And then once the guidance is finalised, from 2025 onwards, there'll be training and transition. And the reason these things take time is the boxes on the right hand side there. There is a need to ensure that there's proper technical rigour, and the process, as we say at the bottom of the slide, is equivalent to international accounting standards setting processes. So there does need to be that time to get the technical rigour in, and to get the stakeholder engagement, the feedback, the consultation and so on, to ensure that the guidance is fit for purpose when it's finalised. Having mentioned stakeholder engagement, if we move to the next slide, there's a map here which shows the extent of stakeholder engagement. We've got pretty much global coverage. The little symbols show where the members of the technical advisory and practitioner advisory groups come from. The black symbols are those countries where we've got country champions have been identified to help work with the IFR project. And also the white symbols are where the donor reference group comes from. And I think the number at the bottom, the number of people that we've managed to engage with as stakeholders across the world now exceeds 2,000 people in over 130 countries. So we've got really good broad coverage in terms of that stakeholder engagement. If we move to the next slide, this just summarises where we're at with that phase one consultation. So the consultation paper was issued in January. We did lots of outreach, and this is where the previous map and the numbers of people come from. Done lots of outreach, we've done webinars and so on. And the consultation closed on the 7th of October. There were two phases to the consultation. The first one was very much a broad overview of the project. Are we going about this in the right way? Is the direction of travel correct? And then the second phase of that initial consultation was about some of the technical aspects and the 10 areas that we think will need to be addressed as part of the guidance. So if we move on to the next slide, this just summarises briefly the responses to part one. So that initial part of the consultation around, is this project going in the right direction and are we in the right ballpark? We've not yet analysed part two because it's relatively recently closed. It only closed last month. So again, we had many events. 965 people from 96 countries attended the events. We got 208 responses to that initial part of the consultation, 21% of which were from organisations and the remaining 79% from individuals. And in terms of geographical spread, it's quite a busy pie chart there. But if you look at that, Africa represented 44% of responses, which suggests a need for this sort of guidance in Africa, which is perhaps not surprising, but important that we make sure we take that on board. Europe was the next highest with a 15% response, and Latin America and Caribbean with 11%, and then all the other regions in 6 or less percent of the responses. So we've got a good feel for where the issues are most prevalent that we need to focus on. If we move on to the next slide, this is a slightly more disappointing outcome from my perspective in terms of audit firm engagement. I was kind of hoping there'd be more audit firm engagement. I am really pleased, however, to say that MHA were one of only 3 audit firms in the world to respond to phase 1. This is based on phase 1. We've not got the phase 2 data yet. And also Baker Tilly Ecuador, which is in the Baker Tilly network, which is the same network as us. So I think this demonstrates, as Sudhir said right up front, our commitment to the sector and our commitment to this project. So I was really pleased to see that we and another Baker Tilly firm who are also heavily into charity and not-for-profit work have responded. Our responses are available on our website, and I suspect we can send a link round later. I've not asked you for that, but we can send a link round later on to our responses to both phase 1 and phase 2 of that consultation. If we move on then to next steps, so that's that consultation finished. We'll be completing the analysis of the response for phase 2 of that consultation over the next couple of months. We'll be issuing the response to that in January, and then finalising the roadmap for the future, which is actually on the next slide. Deepa, the roadmap just sets out at a fairly high level what will happen from January 22 onwards. So we'll issue that initial consultation response in January. And then, as I mentioned earlier on, the intention with the exposure draft, rather than write it all in one go and send it all out in one go and take quite a while to get there before we can issue something, we have concluded that the best way to do the exposure draft and the best way to get the feedback as we go along and learn for the future stages is to split that into 3 parts. So we will be issuing the first part of the exposure draft next September, which will cover 3 of the topics, followed by the second part of the exposure draft in May 23, and the final part in November 23, all of which should give us the time, with the response periods and the consultation responses and time to iterate, should give us the time to get the guidance out and ready by April 2025. So there will be 3 different stages, about 6 months apart, over an 18-month period or so, where we'll be looking to pull all of that together. And then finally, so that's the roadmap for the future. Finally then, what is it all going to look like when it comes out? There's a little bit of an unknown in that at this stage, obviously. The starting point that we proposed in the project and has been broadly supported in the initial consultation responses, that we'll start with the IFRS for SME standard. That's the starting point. What we'll then do is we will add in replacements or new sections for NPO specific matters, and there's a few listed here, there'll probably be others at the end, but non-exchange revenue, grant expenses, the reporting entity and what that is, fundraising costs, and more on narrative reporting that's more NPO specific as well. And then finally, similarly to the previous bit, we'll be taking out those bits of the IFRS for SMEs that aren't relevant to the NPO sector. Okay, so that's a high-level, speedy overview of the IFR for NPO project. I'll now bring us back down to earth in the UK with Stuart, who will talk us through the charity soul. Thanks, Stuart.
Thanks so much, Paul. That's brilliant. So there is a bit of joined-up thinking here, so I'll just do a bit of a recap on where we are up to in the consultation process. Some of you may remember with fondness when the SORT was introduced back in 1988. We then had various refreshes in 95, my favourite, 2000, 2005, and then essentially 2015. So it was on a 5-year track. So one would have expected a potential new SORT in 2020. You've got to ask yourself, what on earth happened in 2020 that could possibly have delayed this process? It was a chap called Joe Saxon. It wasn't COVID at all. But essentially, there was a movement actually about saying, well, actually, what are financial statements? Therefore, are they actually addressing the user's needs? And are they helping public trust, encourage strengthening public trust? And so essentially, a review was done, a consultation by a chap called Gareth Morgan, who worked in Sheffield Hallam University, and he did a wide sort of review of the SORT setting process, the governance behind it, and decided that actually there are a couple of really valid points that have sort of happened over the years, and it was largely felt that actually the SORT process and the setting of it was a bit of a closed door session. Such that it was largely formed by the accountancy profession, didn't really take enough of a sort of wider stakeholder engagement within it. And it was thought that actually if you allowed for that within a process, then you might actually get a SORT that actually encourages financial statements to be more user-friendly. So essentially, Gareth's review looked at sort of a new process, and here it is. It's a 6-stage setting process where you sort of explore, you reflect, you problem solve, you draft, you consult, and you publish, which is, on the face of it, sounds quite nice and easy. So if we go to the next slide, we can have a quick look at the timeline that was expected there. So essentially, the whole process kicked off in early 2020, and it was the idea there is we'd sort of aim to have right at the bottom a sort of a SORT that would essentially come out in 2022 or 2023 at the latest. How is that going? Well, funnily enough, there have been a number of barriers coming into play, and indeed COVID was one. And so actually the timeline isn't quite going to plan. So we are only at the problem solving phase when actually we should have finished that, and it should be into the drafting phase now. So we are, depending on which way you look at it, in terms of the best case scenario, we're about a year behind. In terms of the worst case scenario, we're even further behind that. We're about 3 months behind the worst case scenario. So let's have a little look at why in the next slide. And that's an interesting slide because has that gone too far, Deepa? Never mind. Oh no, sorry. There we go. Why the delay? Well, essentially, in there, I'd probably like to blame Paul and his gang of the IF4 MPOs, which is number 1 on my list. But actually, joking aside, it's probably not. Essentially, that is actually part of the reason. It's a bit more complicated than that, but essentially what we're now grappling with is this whole new process. And what used to happen is you had a SORT making body, which essentially was of the charity regulator and sort of stakeholders such as the FRC, and then you had an advisory committee, which has always been in tow, and that was made up of often predominantly professionals in the sector. So to accommodate Gareth's new process, what they formed is called engagement strands, and 8 of them are highlighted there, and this is to sort of reflect on the various stakeholders, a little bit like Paul was saying in the IFR project. And so you had a very key group from the smaller charities, reflecting that, you know, essentially the largest number by a long shot of charities are actually small, and only a very tiny percentage of charities on the register in terms of numbers are actually large. You have trustees, major donors, academics, professional audit committees, and so forth. There are actually, while there are 8 strands, there are actually 9, because so many people wanted to be on the professional audit and technical team. There are actually 2 strands within there, strand A and strand B. And each strand has between about 5 and 10 people on it, and each one has a convener. Now, if you can imagine, therefore, in order to get any consensus, when a topic or an item is discussed, the SORT committee set the agenda, and then they go out to each of the 8 strands and say, tell us your thoughts. The issue that you have then is each of these 8 strands then, or essentially 9, report back. One of the issues is you're rather assuming that each strand will come to a consensus. They report back through a convener, so each strand has a sort of chair. They don't always come to consensus, and then the SORT committee have 9 different responses in order to then consider, plus their own. And the SORT committee itself is not a small size. There are 4 regulators on there, 1 member from the FRC, 4 from the small charities, 8 from the professionals, and 2 from the funders. Now, not all of those people are actually on the engagement strand, and so there's another layer of independent views going in there. So essentially what the SORT committee has found is every time they put a subject out for sort of debate and essential exploration and so forth, they get back a wealth of information, but it's extremely hard for them to sort of decipher through that and actually come to a consensus themselves. I would have thought that whilst this process is now finding its groove, I would have thought that in future years they may well look at this process and actually potentially see how the interaction with those engagement strands actually goes up into the SORT committee. A sensible suggestion from myself would actually be that each of the conveners from each of those 9 strands forms the SORT committee, and then you have the 4 regulators plus the FRC representative, but I'm not in charge of that. But anyway, it might be a useful suggestion going forward. So just going back to where we are, we've done the exploration phase, and essentially that is where each of those 9 strands were given carte blanche basically, and said, right, here are a couple of sort of broad topics. Where do you feel that the SORT could be improved? And then it's come back to the SORT committee who've reflected it. And essentially what they've now sort of said is, okay, well, here's some of the sort of key themes that have arrived. And I'll give you a little bit of an insight into some of the sort of subjects that were kicked around. We sit on 2 strands, MHA does, and that's the small charities and the professional and technical group. And to be honest, a lot of the themes were very, very similar. There is a huge thrust really from nearly every strand really coming through about the trustees' annual report, the TAR. Essentially how readable it is, what it contains, and how it links between the financial statements. And I suppose that probably goes back to that 10% of you who at the beginning in that poll who actually said, well, potentially the story that a set of accounts tells over the charity's financial position isn't that great, but actually there are greater weaknesses in there about the strategy, worse still about the impact that it's making. And so there was, again, that was some of the sort of themes that were coming out, more of a focus on telling the story. There was an idea bandied around about having a sort of key facts summary at the beginning of your financial statements. And this is all about comparability of essentially helping the public compare one charity with another. We'll return to that in a second. Then we went into the financial statements, and there was a general consensus about reserves largely being misunderstood, and that's both from the preparers' side and also the readers. So we have this concept of free reserves, which obviously is at odds sometimes with the total reserves that a charity holds, those being restricted or designated or held in fixed assets, for example. There was a thought there behind going concern, making it more crystal clear about what the accounts are saying from a trustee's point of view, and also from the auditor's point of view, and what they were actually saying about going concern and when the timing of that statements that were made. So there was general thought that there might be confusion between essentially when the accounts are drawn up to and when they're signed off. Again, there was a bit about impact reporting, and I think this is a theme that will keep coming through. There is a strong push, and this certainly goes back to Gareth Morgan's review and did highlight areas where charities don't really explain what they're doing and why they're doing it. And so there was a thrust from the engagement strands there to focus on impact reporting more. There was an agreement in terms of support costs, how they're misinterpreted. They're often called misplaced with overheads. And are these the nasty costs that the charity should try and minimise wherever possible? The SOFA, actually, is it largely understood? There was an amazing thought there about turning it upside down. What that means is you actually start off with the surplus or the deficit for the year, and then you actually then go through and say how you expended your funds, and then at the bottom you say how you funded it through the income. Not sure that's going anywhere, that idea, but I quite liked it in a way. But I think that the general consensus is it would make charity accounts different from every other set of accounts on the planet, and that probably wouldn't be the best idea. Then we had a few technical bits where people had sort of bugbears, a little bit about the comparatives in there that was forced upon us by the triennial review of FRS 102 to have comparatives for all items in the financial statements, albeit not those on the balance sheet, but essentially it seemed to add a lot of clutter in there. Income recognition, too complex, especially legacy, and they did feel that the SORP made a bit of a meal about it and was very unclear. And then actually a real thrust from the smaller charities is making life a lot simpler. Can we enhance the use of receipts and payments accounts? Can we indeed enhance the use of natural classification? So that's more on a sort of a light heat office, sort of as your normal company P&L would look, rather than on an activity-based reporting in terms of activity 1, 2, and 3 that the charity's undertaken. Is that an easier way of portraying the financial results of smaller charities, and is it more beneficial? So all of those were sort of bandied around. So if you go to the next slide, deeper, we then sort of, after that went back to the SORP committee, they reflected on it, and they also reflected on the timetable, because in the background here we have two issues. One is the IFR exercise that Paul's talking about. Essentially, we can't ignore that, because essentially that may change the way that our SORP it looks and feels. But at the end of the day, that's still, as Paul's demonstrated, still quite in its early stages. So it's just got to be at the back of the mind. More front and centre is the FRS review that's coming around again. And essentially, we're expecting another review of FRS 102, which will come out for accounting period starting the 1st of January 2024. So the new SORP has to be out ahead of that. And therefore it's squeezed the timeline. Essentially, I mentioned there we're about a year behind. So what they decided to do is bang the sort of problem solving bits and sort of reflection bits together. So they would then come out with sort of 15 topics, and then that would focus the engagement strands on those 15 topics, really narrow down the range, and they were really hoping that they can still get a new SORP out by 2023. So if we go to the next slide, we can then have a look. And the first, I say there were 15 topics that were selected, but the first one is more overarching, and this was about the tiering. And this was a real issue that was bandied around at the beginning about saying, why can't we simplify things for smaller charities? Is it right that we just have large and small? And actually, is it proportional? The issue went round and round and round. Essentially, it was decided that, okay, fair enough, we think we need another tier. But actually, one of the ways of getting a new tier would actually be looking at the application of Section 1A of FRS 102, which isn't permitted for public benefit entities. So a request has gone off to the FRC to see if we can adopt that, can get an exemption for the FRC to move that. We don't know, that's gone away and it will come back. But what's likely to happen is there will probably be 3 tiers. It's likely that actually small will stay as it is, less than £500,000 of income. Medium will then be from that stage up until a certain point. One would have thought either it's going to go to the 1A Companies Act requirements or somewhere around that region, and then there's going to be this new area which will be for larger charities. So essentially I think what we'll end up with is what we've got already plus a new tier for the larger charities that we'll add on the end. But that's all yet to be decided. If we can go to the next slide, please. So I think what we're going to look at now is, here are the 15 topics. It's fair to say that we're heading through them at great speed. So we're pretty much about 75% through those. Again, this is at the engagement strand level, so then it will go back up to the SORP committee to corral all of the ideas that have come from each engagement strand. But I thought I'd just give you a little flavour. This has to be done by the 10th of January 2022, so we're really in the sort of final throes of that. So if you go to the next slide, essentially some of the sort of ideas that are coming out of this. Some of the real techie points in some of them about related party transactions and disclosure notes and how that can be problematic when non-disclosure agreements have been signed, very techie bit, but also next one is grant expenditure. How can that be simplified? Because there's a real thought there that you're allowed, if you're a grant giving charity, you can disclose your grants that you've given in the year on your website, and you can do a link from the financial statements to the website, although there's a huge feeling there that actually that becomes out of date, and it's difficult because once a set of financial statements is done, that website might be live but the financial statements aren't. So actually, could we simplify the disclosure so it could be contained within the financial statements? Legacy recognition criteria. Real interesting debate on this one. It was actually the best recommendation I heard coming out of it was actually saying, you know what, this is complicated. It would be much better if we had a more prescriptive method, and the best person to come up with that would be a legacy expert. So that's one idea that's sort of coming through, is to see whether that can happen, or is it potentially a cash basis permissible on that one. The upside down sofa again came out again, but I think that's been shot down enough now that we probably won't see it. The nasty costs, the support costs, that was an interesting one. Essentially, there's an idea there to actually abolish it, which could be interesting. Essentially, impact, where that went, and Jim will talk a lot more about that, where that came to was essentially the word impact was really decisive, very decisive indeed, and actually it was found to be helpful to actually get rid of it and actually just talk about the difference made to beneficiaries. Because if you compare that to the other side of impact, which is sometimes talked about more widely, and that's the impact on the wider public, it's felt that there are two different interpretations of impact. And actually, it was such an emotive statement that arguably the SORP should make the distinction between the two. So one thought is that the difference made to beneficiaries, which is actually currently just a should in the SORP, actually becomes a must. So you must disclose what difference you make to beneficiaries. And then I think there may be a may or a should talking about the wider impact on the public. And then the other one is about reserves, and actually whether there's a neat solution there to actually, rather than have free reserves that pop out of your reserves policy in the trustees report, actually have a link and a note to the financial statements which explains the calculation on how free reserves are made. So actually it's a bit more understandable. So that's a whistle-stop tour through some of the ideas that are bandied around. As I said, it's still in its formation stage. It will go to consultation. And essentially the wider angle there, which essentially will start that process of consultation and review, which will have to feed into the FRC and the FR for MPOs. That will start to happen in early 2022, and so we'll really get a better feeling for how that's coming along. And I think there'll be various consultations on various segments. as they come through. So keep your ears open. I'm going to hand on now, I think, to Rich and Jim to do the next section.
Thank you very much, Stuart. That was very helpful indeed. It's interesting that the points are coming through about the increased amount of impact reporting. So if we can just move on to the first substantive slide. Thank you. Financial reporting, as you've heard, or as you're well aware, is covered in the SORP, and the equivalent in reporting is picked up for non-charity social enterprises. The SORP, as we know, requires trustees report to explain what the charity does and how it does it, and to confirm and explain how it's delivering public benefit. But then, as you've heard on the SORP consultation, there's that question of what difference is it making to beneficiaries? What difference does it make to the wider public? It's begging an extra question. And that's really responding to the point of, do the publications that are generally made at the moment meet the requirement of funders, of donors and supporters? And indeed, do those show the charity in the best light possible, champion its work, explain how it delivers its benefits, and encourage commissioners, sponsors, delivery partners, volunteers and others to get involved? Well, this area is really opening up and gaining considerable interest. And we're seeing major development in two particular arenas. One is in impact reporting. By impact, I mean the difference made deliberately caused. So that's explaining what difference the organisation is making, how it's doing that, and which stakeholders benefit. We're seeing that coming through in both the charity sector and the private sector, indeed. And the second one is around ESG, environmental, social and governance, developing a more meaningful explanation of how the organisation is risk managing the impact that it has in those three arenas. We're going to take you on a whistle-stop tour of these areas at fairly high level, but we want to explain what's happening, what it's like in practice, giving you some examples, and what this might mean for you, really begging some further conversations and some further thought. So over to you, Rich.
Okay, so yeah, as Jim says, it's very much on the up. The focus across both ESG and impact, and in particular from an ESG perspective in the corporate sector, and that will have a knock on, as we'll discover later, and we'll walk you through that. You know, in terms of what's the difference then from an ESG perspective, it's the focus on explaining and measuring the efforts an organisation makes to reduce and address its environmental and social risks across its operations, supply chains, value chains, and the governance over such. And one of the key themes that we're seeing more and more recently is actually, it's not just the actual material issues and risks, but actually what was the methodology that you arrived at to take you to those material risks, and, you know, give a sense that you really understand what they are is becoming increasingly important. And then from an impact reporting, it's more the focus on the change, you know, social, environmental, economic terms that an organisation is trying to and does by achieving its activity, and sometimes in doing that, potentially putting economic values on it, as Jim will explain as well. So very much an emerging theme, and with a lot of focus coming on. So I'll just hand back to you, Jim, for the next slide.
Okay, so impact, I defined that just now, the change deliberately made to the extent it's down to what you're doing. And Stuart was talking about the impact there for beneficiaries, but also the impact on the wider public and the state and the system. And social, so much of the impact reporting is about social. There's quite a bit of what we do in the charity sector is focused on social causes. Social as between people, with communities, it's about relationships, and it's about the effect we have on individuals' relationships with themselves, their well-being. And that is contrasted with the environmental, which is affecting the wider environment, take the people out, and that's the bit that you're left with, and the economic side of improving the distribution of wealth and inequality. They're all interactive. Thinking about a few resources, particularly on impact, which I can point you. Paul was talking earlier on about the international coming together of people to solve problems. The GECS, that's how it's pronounced, was a group, is still a group that the European Commission brought together to explore the social business across the European community, and among other things, it produced a set of impact measurement standards and guidance as to how to measure. Those then fed into the work by the G8 and the Social Impact Investment Task Force, which substantially followed GECS and built on it, and that fed into the Impact Management Project, which again clarifies and interestingly brings in the idea of impact risk. So those three as sources are really pretty good, solid and mainstream. So what are organisations doing at the moment? Well, the key word I'm going to keep coming back to is articulating. Articulating meaning explaining, making clear what they're doing, what they're achieving, how they're doing it, and for whom. Some refer to that as a theory of change, but increasingly we're hearing it in that articulating terminology. Identifying the stakeholders in that change. So if you make that change for the beneficiaries, for the community, who else benefits or who suffers a disadvantage? And then building some frameworks, lists of outcomes, changes you might be measuring, and some metrics that you might put against those. But I would emphasize again this point that articulating is the key bit. Making it really clear what's going on and how you're doing it. This is not measurement led, this is articulating the story first. Be proportionate, the GECS standards talk about that. If it doesn't matter, don't measure it, and make sure that the amount of time you're spending on the measurement doesn't dwarf the project. Think about creating impact through three means: through the work you deliver, through the leadership you show within a sector, taking others with you, encouraging others to go on that journey and create a combined improvement, and the influence, the things that you just call out, speaking truth to power and make a difference. It's quite a helpful way of categorizing it. And I come back to this point that there is a growing interest from wider stakeholders in this whole area. People are asking for it. We're seeing commissioners and other revenue providers, including customers in some sectors, looking at the private sector, capital investors, banks, social investors, and increasingly the mainstream funders, look at the housing sector, for example. Staff, existing and new recruits are encouraged by it. Supply chain, organisations that are looking to supply you may be looking to their work being included in a more impactful organisation. And finally, partners in delivery, both private and social sectors. Over to the next one, please. Next slide. Great. Just wanted to give you a few examples to illustrate that point about the emphasis on articulating the value. So NHS England commissioned a piece of work. These are all projects that we've worked on recently. NHS England wanted to understand and articulate, it was actually in the title of the brief, the role and value of nurses within general practice. We know they're great. We know they do some amazing things. What do they do? How do they do it? How do they interact with the rest of the profession? And this shows factors that are driving the value and 4 arenas in which they're creating that value with the patients, within practices, within the wider community and the NHS as a whole. Interestingly, it didn't pin down lots of pounds values, but it did show what the value was and describe it and explain it. Safe families help 1,400 or so families a year facing very difficult situations, very isolated and lonely, and at risk of the families breaking down. Safe Families works with trained volunteers, befriends and supports them at multiple levels. And this piece of work understood the characteristics of how they engage with the families, the situations in which they most have impact, and so was empowering in engaging with commissioners, but also helping Safe Families to understand what levers to pull and what was really working. GamStop, thirdly, is an online gambling self-exclusion scheme. If you don't want to do online gambling and you feel drawn to it, you can lodge your details with GamStop and that will block you from online gambling sites. Question was, is it working? How is it working? This explored how, with no natural social blockers, like walking into a betting shop, this is a pervasive problem that is hard to avoid. So this explored not just does it work and demonstrated it does, but how and how to enhance it. Back over to you, Rich.
Thanks, Jim. Come over to the next slide, please. So what's happening in ESG reporting? I've been involved in sustainability, which I class as ESG because I've been involved in it for so long, I guess, for getting on for 20 years, as Sudhir said at the outset. And in that time, I've not seen anything like the level of focus and scrutiny that we're seeing on ESG at the moment, particularly in the corporate world and UK PLC, but certainly moving across different sectors. So, we vastly increased, not just to focus on what people are reporting, but actually the use of ESG screening from the investment community, actually in its widest sense. Used to very much be the domain of things like impact investing, green funds, ESG screening, ESG funds, etc. It's now in the main market. So, if you're a large charity, you could well be falling under some of the reporting on this, whether it's voluntary or the compliance side of things. We've seen a big increase in the compliance side of it. We've got task force for climate related disclosures coming in. I'll touch on that on the next slide, but also voluntary reporting, because there is so much focus on this from the investment community, as Jim's alluded to, other stakeholders, customers, supply chains, staff. Everybody's very interested in what's going on within ESG and the purpose of the organisations that they're working for and working with as key partners. So we've also seen an increase in the voluntary reporting, whether that's some things like the UN Social Development Goals, global reporting indices, or just companies trying to put a more transparent lens on what they're doing in their wider operations beyond just the sort of money-making side and how that interlinks with the environment, the social and the governance over it. We have seen the increase in the compliance side, TCSD. We've had streamlined energy and carbon reporting as well. And we're also seeing this trend actually towards moving to non-financial assurance over the metrics as well, because so much emphasis is being placed on ESG, particularly by the investment community. If you place some kind of non-financial assurance over those metrics, you actually enable some higher ESG scoring criteria. So those are the sort of key trends from that. I guess what's sort of happening within the different strands from the environment side of things. And obviously at the moment we've got COP as a background. There has been very much a focus on climate all year, but there are key pieces of legislation coming in, such as the ban on single-use plastics. So very much the other pollutions and waste are key within there, resource intensity and sustainability, and then biodiversity loss and healthy ecosystems are all things that people are looking at. From the social side, you know, very much about your talent, your diversity, equality. What are you doing about labour standards? And again, that can be over the supply chain side of things as well. A real focus on product quality or service quality, and you know, what's happening around those products, you know, whether people can place reliance on them, and the impact of those. And then finally, from the governance side, which is perhaps where we're seeing some of the most focus, and I said, you know, at the outset, more focus on the methodology employed rather than necessarily just the material risks. It's gone way beyond compliance into accountability, transparency, talking about what you've done well, but also where your challenges are, and actually the participation. So, you know, where are the board on this? You know, where are key people? Are they in attendance, etc., etc. So that's the ESG. And then if we can just move to the next slide, I'll talk about Task Force for Climate Disclosures. And this is useful from two sides. One, it's getting rolled out across the spectrum and could hit the charity sector in the not too distant future, but at the moment it's very much focused on UK PLC and the banking sector. Driven very much by the banking sector initially, but the government have talked about making Task Force for Climate Related Disclosures mandatory, and that is now starting to roll out and down to large organisations, so those of over 36 million turnover, 18 million balance sheet by 2023. The key thing about the Task Force for Climate Disclosures, it's a bit of a game changer. We're no longer just talking about what our results might be. So if we sort of look at it again, streamlined energy and carbon reporting, where you will be talking about, this was my footprint, this is what I focused on. You know, TCFD is asking you to look at how climate change affects your organisation strategically over the short, medium and long term. So that can be the 5, 10 and 30-year time frames. How is that impacting your strategy? How is it impacting your financial risk? What are the opportunities as well as the risks? And then you have to make 11 disclosures on that, 2 on the governance side and then 3 across the strategy, risk management and metrics and targets. It's been driven very much around the belief that the better that climate related disclosures are, the better financial decision making will be. So again, this is all about someone being able to sit and compare strategies, impacts and decide whether they're putting the money there, whether that's a partner, whether it's an investor. What's key about this is that actually we've extended the risk horizons to potentially 30 years, but we're also asking for different types of risk analysis. So things like scenario planning, which, you know, the banks are used to, the insurance sector are used to, but the rest of the UK isn't necessarily used to using scenario analysis particularly frequently. And even for those banks and the insurers, they're not used to using it over a 30-year time frame. So, you know, this is a sort of no holds barred look at where this is going to affect you strategically and what you've done about it. So it is a bit of a game changer, and we're going to have to see some skilling across several industries to sort of meet those requirements. So I think that's probably it for TCFD. So back to yourself, Jim.
Okay, thanks, Rich. I wanted to give a quick example for you of some of that ESG reporting coming through in the charity sector. In this case, it's an exempt charity, so it's Hyde Housing, a housing association. There, in the housing sector, there is a sustainability reporting standard that exists, but is a minimum benchmark. And Hyde are looking to show some of their ambition and where they're trying to move this to. This is a clip from the report that's available on their website if you want to have a look. It gives 3 sets of 8 indicators, one in 18E, 18S, 18G. It links back to the organisation's impact measurement, and I'm just showing the environmental progress one here. You'll see they have picked those 8 factors and they've set a 2020 baseline. They're showing where they are on the current year on a progress to a 2030 target. So it's very clearly showing the direction of travel and is engaging very well with investors. Okay, over to the next slide. And I wanted to look at where we might be going on the impact reporting. There's a very firm theme here of using the story or the life course properly evidenced and explained, so not vague and fluffy, but as a basis for metrics. Now, this timeline that you'll see superimposed on the picture is a clip from that NHS England report, and it looks at what's happened to a particular case of an individual who's had involvement with the nurses. And you'll see how it's using the storyline. The black is what would have happened, the green is what did happen with the nurses' involvement, and then puts price tickets along that line as a structure. So there's a clear and engaging explanation of how we do what and for whom, and then a framework of the outcomes aligned to the needs of the individual. Situational analysis, slightly techie term. It's what is the situation and the state of the person you're trying to help? What are the factors around them that are affecting them, that compromise them and that compromise delivery? Very important to flesh that out. Just wanted to pick up on a few frequently asked questions in this area. So what about the Sustainable Development Goals? Are they a framework? No, they're not really a framework for impact measurement. What they are is a helpful reflection of a number of relevant arenas in which your work might be seen. So using it as a mirror into which to reflect your work is pretty helpful. Stories, that comes through strongly in the GECS standards, the G8 and so on. Well-founded, well-evidenced stories are core, and the measurement needs to illustrate those, rather as accounts, of course, illustrate the transactions that have been going on during the year. Should we use pounds evaluations? Only if it's useful and not distracting. In the nursing report, it's illustrative. In some other reports, it's been key. But only put it in if it's useful, relevant and helpful, but always articulate and explain. And finally, should we publish separately or just in the annual report and accounts in the trustees report? I would say publish separately to give enough underpinning information for this to stand as good, well-founded, evidenced work, and then reference it and explain it and draw from it into the accounts. Back to you, Rich, and the next slide.
Thanks, Jim. So in terms of the ESG side and the considerations, it's key when you're sort of looking at what you're going to report on, that you understand the full audience. And I've sort of alluded to already, the increase in reporting is almost like a vicious cycle. The more people that report on it, the more comparisons can be made against you, competitors, other charities, whatever it might be in terms of what you're doing there. It's not just the investors. There's a significant focus from media, which again is creating some interest. It can be commissioners, particularly your corporate partners, the people that are reporting on this, as we've alluded to already throughout, are very much starting to use these methods to assess the corporate partners they're going to work with. Are those impacts going to enable them to impact their own goals and objectives? And what's the wider stakeholder side of things as well? Almost the license to operate. What do you need to consider? And the sort of wheel on the right is actually the ESG, one of the ESG screening tools. So some of those will be relevant. A lot of them might not be, and that's the other key point here. Is actually make sure when you've boiled that down and you've got the key things that are important for your stakeholders, you do fewer things and do them very well and articulate them well and be transparent about them, rather than trying to cover off everything that might be in that wheel, because that's just too much and you won't be able to do it particularly well or talk about the impact thereon. So it doesn't need to be proportionate. And then the sort of other thing that I've mentioned a couple of times, that the methodology can absolutely be as important as the outcomes. We're talking about some difficult subjects that, decisions we make now, and keeping an audit trail is key too here. Decisions we make now in 5 years' time with a changing environment, for instance, new technologies, whatever it might be, in the cold light of day might not make as much sense as they did to us here. And so having the methodology and knowing why you've made those choices is key too. So that's that from me.
Okay, last couple of thoughts then. What you were saying there, Rich, resonates very much with me. Just this morning I was talking to a client who is establishing a new charity group and is being asked by grant funders, major grant funders from Europe, about ESG reporting and can the ESG certify the organisation. And we're looking at putting together a combination of an impact report and a selected topics ESG report, just to explain quite how well this scores on both categories. So the opportunity for you all is this question about, will you articulate your value? Will you explain it? Will you explain how you're delivering it? Will you illustrate it? And will you use evidence stories to do that? And then secondly, the ESG strategy. What are you doing to manage risks around it and engage well with stakeholders? There is a real opportunity, very important to keep it proportionate and to be selective, but there's a real opportunity that for you to grab and get ahead with and make sure you define what it should involve that suits your operation. Sudhir, back to you.
I think Sudhir may have some internet issues, but I think that's the end of our presentation today. So thank you very much for everyone who's spoken. I think we're now going to open up to any questions. So please feel free to put them. Oh, indeed, here he is back again. Hi, Sudhir.
Hello. Sorry about that. I think my internet just went down. Did you manage to get to the end?
We did. So I'm just opening the floor up to questions.
Oh, thank you. Yes, if there are any questions, please do ask them. Just while we wait on that, gentlemen, really fantastic presentations. I've learned a great deal. One of the things I think we had noted to us was there's a lot of comments about narrative reporting in all your talks. So I think the question I was asked was, how much do you think trustees' annual reports will need to change in the future, and do charities need to be starting to think about that now?
Shall I go first, because everybody's sitting there looking on the screens? I think some of that comes back as well, Sudhir, to that initial poll that we did about how well does the current framework reflect all those things that we had on that list, and there were quite a few of those that were narrative related that weren't really very highly scored in that poll. So I think there probably is a need to change quite a bit. I know in our project and all the other stuff we've talked about, there's got to be rules and regulations around it, but I'm kind of hoping there won't be too much of a rigid framework, and that it'll be much more of report on what you need. I think Jim used the phrase measure what needs to be measured, and if it doesn't need to be measured, don't measure it. I think it's the same narrative report. Say what needs to be said. If it doesn't need to be said, don't. So I wouldn't necessarily see that we're going to get to 200-page narrative reports and things like that, like you see in some of the larger listed market and stuff like that, but it will need to evolve, I think.
Yeah. And Stu, do you think the same from a UK viewpoint?
Yeah, I think so. I think it's always been an interesting question that I've always struggled with myself. Is we're constantly trying to address the needs of the users of the accounts, but I always go back to saying, well, who are these users, and are they the right users? And who really are we trying to actually encourage in here? Because if it's the wider public, then you've got to, at some point, put your pen down and say, this is a financial reporting document. At the end of the day, this is going to not be that interesting to a certain percentage of people. So actually, what are we trying to do here? And the more you go over to the sort of discursive and sort of objective side of things, then you start clashing in terms of the auditing of that, and it becomes increasingly hard for an auditor to put a sort of true and fair opinion when they're looking at the consistency of that financial report, because once you start delving into the data and giving out key figures, then we have a duty to look at those. So there is a real dilemma there. If it was down to me, I pretty much follow what Paul said, and what Jim said as well, is be quite succinct about what you're saying. You must talk about what difference you're making to the beneficiaries. That's just fundamental of who you are in my book. And actually the wider piece there is useful to know.
Yeah, thank you, Stu. I think we probably just got only a minute more for questions. There was one rich comment really about ESG reporting, saying just thinking about the fact that ESG reporting, often people look at websites and social media. So what do you think about that in terms of ESG reporting as opposed to in the financial statements?
I think it's an interesting one. I mean, so at the moment, the investment community is fairly clear that they want all the information in one place, and that means it's going to have to be fairly succinct. And I think then that leaves the sort of richer detail of what you're doing potentially put onto your website. I think there is a lot of social media. There is increasing focus. So we are starting to see integrated reporting within the corporate side, but more succinct sustainability and ESG reporting on the websites. And again, it's the clarity about what you've done and why you've done it that's as important as trying to have really long reports and sort of picking up on some of the themes that we've just discussed there. I see some fairly big sustainability reports and it takes me some time to get through them. So, if you're not a sustainability and ESG professional in 20 years, I can imagine they're pretty interesting things to try and read through. So I think we're seeing more in the integrated reporting side of things, but then some real clarity and perhaps more of the storytelling, what did we actually do, what's the impact on these particular groups, coming out more and more actually within the website reporting side of things.
Yeah, thanks, Rich. I think, yeah.
Go on.
Yes, after you, Jim.
I was just saying that Shabir in the questions has raised this question about proportionality of reporting. So what do smaller charities, he's saying that's up to 10 million turnover, which is still a reasonably substantial charity. What can and should they be doing? And are they, I'm assuming, are they going to get forced into disproportionate reporting if we're not careful?
I think from the international perspective, that's the main reasoning behind starting off with the IFRS for SMEs rather than full IFRS, for example, to try and take account of that proportionality. And again, within that project, as we're developing the exposure drafts, we will be mindful of the range of organisations that will be impacted.
If I can just add on the impact reporting, and indeed picking up Rich's point on the ESG side of things, articulating, again, I use the word, explaining what it is you're doing and why that change is expected to occur. I think that is absolutely fundamental. And to be honest, if most charities, if they couldn't have a fair shot at that, they probably need to think about why are they doing this. So explain it, bring it to life, but then once you do that, try and pick some fairly straightforward metrics around it that really do illustrate to your audience whether you're achieving what you're achieving. If it's getting people back into work, how many people get back into work and how many people stay in the employment market? Really, really simple metrics, not necessarily, they need a bit of a labour of love to gather them, but they don't need to be overcomplicated metrics. The complexity is in the story of the people that we're helping and the complexity of their setting. And that's something in the charity sector we just live with and live and breathe. So complex stories articulated simply, keep the metrics simple.
Brilliant. Thanks, Jim. Well, I think we've seen Sudhir's internet has finally given up the ghost. So I think it leaves to me really to close the webinar if there aren't any more questions. So many thanks for attending today. As Sudhir mentioned at the beginning, this is being recorded. It will be available on our website. If you do have any follow-up questions, please do get in touch. We're more than happy to answer them. My final thanks go to Paul, Rich and Jim and Sudhir in the ether, wherever he might be, and Deepa for helping us organise it today. So thanks very much for your time and really good to see you. Bye for now.
Thanks, everyone.
Thank you.
Thank you.